I wanted to start with going deeper into understanding what compounding really means to you.
Albert Einstein had very rightly said that compound interest is the most powerful force in the entire universe. So what happens when you apply such a powerful force to knowledge building? You become a learning machine. And if you look at all the successful people in the world, all of them embrace this attitude of lifelong learning. So that was the approach.
Your interactions with Mr. Warren Buffett also, because it's not like too many people have the privilege of being able to interact with him.
But I still went ahead with sending him the manuscript of the book along with a very heartfelt note talking about the objective behind this particular book. And I think the core message of the book, which is compounding, really resonated a lot with Buffett. Basically, Buffett stands for compounding and Charlie Munger stands for lifelong learning. So when both these elements came together, I think that is what really made Buffett write such a nice words of praise for the book.
And then we were also talking about how India has multitude opportunities, whereas in the US it's mostly focused around Mag 7.
One very unique statistic about India, Shrishti, is just look at the last decade. 103 of the BSE 500 companies have become 10 baggers. So 1 out of every 5 companies in India has given you almost 1,000% return in the last 10 years. No other stock market in the world comes close to this level of wealth creation for investors. So India is a great market for active stock pickers.
What are some of the things that you are personally very bullish about, or which you think are very contrarian and not fully discovered yet?
Gold is as a neutral reserve asset. As people try to diversify out of the dollar and into gold, I think gold financiers in India especially, I think they are in for a very good time ahead.
You don't think are investable, but might be very hyped up in the media or might be the talk of the town right now, but you don't see the long-term future or prospects there.
Investing is always bottom up. So, even though I mentioned defense a short while ago.
Hello and welcome everyone to the India Opportunity Show. I'm your host Shrishti. I'm thrilled to welcome Mr. Gautam Baid on the show today, who is an internationally acclaimed author of the book called Joys of Compounding, which has become a modern day classic and is rooted in timeless wisdom from the greats such as Buffett, Munger, and many more legends. Gautam's journey is nothing short of unconventional. From doing night shifts at a hotel to now managing capital of investors in the US. He's built a career on first principles thinking, voracious learning, and humility. He's a practitioner of value investing and lifelong learning, and a powerful advocate of discipline and delayed gratification. In this conversation, we go beyond investing. We talk about mental models, habits, and the frameworks that you can apply in your daily life to become a better thinker and decision maker. Hope you enjoy watching. Hi Gautam, welcome to the India Opportunity Show. Such a privilege to have you here with me here today.
Thank you, Shrishti, for having me on the show.
Thank you for making time on a Sunday and driving from Noida just to be here for the show. Gautam, you are an author of an international bestseller, a big name in the value investing world, and you truly embody and live the joy of compounding in many different ways. I wanted to start with going deeper into understanding what compounding really means to you and how you've applied it in your life before we start diving into timeless principles and frameworks, etc. This is where I wanted to start the conversation.
Sure. So, the subtitle of my book reads as The Passionate Pursuit of Lifelong Learning. And Albert Einstein had very rightly said that compound interest is the most powerful force in the entire universe. So what happens when you apply such a powerful force to knowledge building? You become a learning machine. And if you look at all the successful people in the world, Shrishti, all of them embrace this attitude of lifelong learning. So that was the approach and the attitude which I wanted to bring out to the value investing community through this book, that treat this as a way of life. Basically, value investing is not just about stocks and business fundamentals. It's something much more deeper. It's more about living a life which is aligned with your value system and helping others. And that leads to a very fulfilling life. So that is where the real power of compounding lies in my view. It's not just wealth creation. That is just one aspect. It's about thinking long-term, embracing a long-term mindset, ignoring all the short-term noise, and becoming a more calm and rational person. That's what basically the book is all about.
Yeah, let's talk about ignoring the hype and the noise, because we were just talking about how the younger generation has lost patience in a big way, right? And how do you truly reap the benefits of compounding if you don't have patience in life? So how have you inculcated patience over this period?
Well, Shrishti, just with regards to investing, patience with good quality businesses having growing earnings is the key to investing success. This is something which all of us know, but how do we embrace that long-term mindset to ignore the short-term noise? It's by focusing on the two to three key variables that really matter to an investment situation. So if you look at any business listed in the market, you'll end up figuring out that at the end of the day, it's just two or three key variables which drive the bulk of the returns or the growth of any business. So if you just keep a razor sharp focus on what really matters rather than the short term noise or short term disruptions, which will not really matter in the long run, that is how you're able to keep a focus. You have to separate the long term signal from the short term noise, and you do that by embracing inactivity and devoting more time to reading, learning, and improving your thinking. That's basically the way to have a long term approach to investing.
Yeah, absolutely. And I do want to digress a little bit and talk about your interactions with Mr. Warren Buffett also, because it's not like too many people have the privilege of being able to interact with him or even receive letters from him like you did in your case. What do you think triggered his response to you, or what do you think you did right to be able to hear from him?
Well, when Columbia Business School Publishing offered me a publishing opportunity with them, it was like a dream come true for me because, as you know, all value investors have a dream of working with Columbia someday. That is where value investing discipline originated from. Benjamin Graham used to teach investing at Columbia. Warren Buffett learned from Ben Graham at Columbia. So it was always a dream to get published by Columbia someday. So when they offered me the publishing opportunity with them, it came with one big caveat and one big condition that you have to get a formal approval from Warren Buffett for including his copyrighted content from his shareholder letters in your book. And my response to Columbia at that time was, it's nearly impossible. Why would he approve my request? He must be receiving hundreds of such requests every year.
Yeah.
But I still went ahead with sending him the manuscript of the book along with a very heartfelt note talking about the objective behind this particular book. And I think the core message of the book, which is compounding, really resonated a lot with Buffett. Basically, Buffett stands for compounding and Charlie Munger stands for lifelong learning. So when both these elements came together, I think that is what really made Buffett write such a nice words of praise for the book. And that really changed the trajectory of the joys of compounding from there.
Yes, we will definitely include a picture of the note, which I saw on your Twitter as well. But tell me, you've been to several Omaha meetings and you were talking about Berkshire Hathaway, like being in a 40,000 environment with like-minded people almost feels like a cult. It's truly, one of those places and experiences that even I would love to experience. But tell us more about that experience. How has it been for you?
I've been going to the Berkshire Hathaway annual meetings since 2016. And like you rightly said, more than the annual meeting, it's more like a festival for value investors every year. It's like an annual pilgrimage where we go and get to interact with many like-minded people because our value investing community is very niche and very eclectic and very limited around the world. So to come at a single location where you have thousands of like-minded people, it just gives you a different kind of high. And you get to when you're meeting and interacting with like-minded people, then you realize that okay, you're not the only person who's very different than others. There are many people who are thinking just like you, and you basically get to learn and grow together. So it's a great experience going there every year.
Yeah. So now coming back to the topic that we wanted to dive very deep into, value investing that you were just talking about. Tell us about your journey in terms of becoming a value investor, because I know when you started out, you did make some risky investments. And I think that's everyone's journey when they start. But let's talk about your journey and share it with the audience.
So like most new investors in the stock market, I was also attracted in the stock market out of sheer greed during the final euphoric phase of a bull market. In my case, it was the 2003 to 2007 bull market in India. I remember I had bought a stock named Ispat Steel in January 2008 and a mutual fund called Reliance Power Sector Mutual Fund in late 2007 because both of those investments belong to the hot and fancied sectors of power and steel at the time.
Yeah.
And both of them had recently appreciated sharply in a very short span of time when I first noticed them. So I went ahead with investing in them without paying any regard to their valuations or business models. And I eventually paid the price. Both those investments crashed 70 to 80% within 12 to 18 months of my purchase. And I'd successfully gained admission into the stock market by paying my tuition fees. And what was the lesson learned from that experience? It was that recency and vividness biases are very powerful but highly costly behavioral mistakes. Recency bias is all pervasive in a world where we tend to extrapolate the recent trends into infinity, but we end up forgetting that the entire world is cyclical. It's all full of ups and downs. Whereas vividness bias basically means, amplifying a certain event in the media or through graphical means and which catches our attention and we get swept away in the short term noise without realizing what we need to focus on, which is the long term. So these were the two big learnings from me from that experience to avoid these two biases. Now, I was working with Citibank and Deutsche Bank for the first 7 years of my professional investment banking career as an investment banking analyst in Mumbai, London, Hong Kong. But despite the bad initial experience in the stock market, my interest and curiosity about the stock markets remained very high throughout the first 7 years of my professional career. And one fine day, I came to the realization that, hey, I just have this one short life to live my dream, and I'm not going to waste any further time doing something that I'm not truly passionate about. Like Steve Jobs has very rightly said that to do truly great work, you have to love what you do. So I was so keen for a career shift or a industry shift that I relocated to the US in 2015 without any job in hand. One of my relatives who's a US citizen, he sponsored my green card. I was under the impression that since I'm a CFA charter holder and this particular degree is highly valued in the investment management industry, I will easily land a job on the stock market side. But as you know, life is not a bed of roses for those trying to carve their own destiny. I got rejected in the first 3 stock market job interviews in the first 6 months of reaching the US. And but I did not give up because I was very firm and adamant that I'm not going to go back to my previous field of work of investment banking, where the presence of perverse incentives constantly led to incentive cost bias and conflicts of interest and did not suit my personal nature. At the same time, I ran out of whatever little money I had brought with me from India, and to take care of my living expenses in the US, I did not want to sell a single share from my portfolio of Indian stocks because I did not want to interrupt the process of compounding. So I took up a minimum wage job as a front desk hotel clerk in San Francisco, where I used to work in the graveyard shift for more than 15 months. For those the audience who are not familiar with the term, that shift refers to the one which runs from 11 p.m. at night to 7 a.m. in the morning.
It's brutal because you don't get to sleep.
Yeah, it was pretty tough. So even though it was a big struggle for me, intellectually, physically, culturally, and emotionally, today in hindsight, I highly value those days of my life, Shrishti, because for the first time since the beginning of my busy professional investment banking career, I finally got time for myself to read and learn. And this was the phase in my life when my learning curve really took off from a very tiny base. The pace of work at the hotel from late night to early morning was pretty slow.
Yeah.
And I made full use of the free time to read every single blog article published on blogs like safalniveshak.com, funduprofessor.com, microcapclub.com, basicinvesting.com, and janavwordpress.com, among others. And the passionate pursuit of lifelong learning had finally begun. So, that is basically when when my foundation in the value investing discipline really started getting built over those 15 months at the hotel. And after that is when I got to experience the power of compounding knowledge in action, because I used to apply to a minimum of 3 jobs every night for a stock market job every night in the hotel. So as you know, every time we take out the time to fill out the job application, attach a resume, and every time we click the submit button, there is so much hope attached behind every single application. Over those 15 months, I'd applied to more than 1,300 stock market jobs.
1300.
1,300.
Wow.
So to be rejected more than 1,300 times and still keep on going is only possible if you're truly fiercely committed and passionate about what you want to do in life. I was receiving a lot of interview calls for investment banking jobs, which would have had very high dollar salaries. But I was very clear, I want to work on the stock market side. This is public markets is what I love, and I'll be patient about it. And luck, chance, serendipity, and randomness have always played a big role in various aspects of my life till date. One fine night during November 2016, I was just during the course of my routine online job search. I hit the quick apply button on a job on LinkedIn, and wonder of wonders, I was called for the job interview, and that too for a senior role in an investment firm. And this was the phase in my life when I realized the power of compounding knowledge in action, because all those hundreds of hours I'd spent for the last 15 months at the hotel had now built a strong intellectual foundation for me in investing. This is what I was lacking during the first 6 months of reaching the US. This time I was able to ace all the 3 rounds of my job interview because, as you know, self-confidence body language derives from confidence, and confidence comes from knowledge. So I landed in the role of a portfolio manager of global equity strategy with Summit Global Investments in Salt Lake City, Utah in US. They're a very big mutual fund company there. And it was like a dream come true for me because never in my wildest dreams did I imagine I'll become a portfolio manager straight away. I thought I'll start off as a junior analyst, then work my way up to analyst, then work my way up to senior analyst, then assistant portfolio manager, and finally reach the position of portfolio manager after 13, 14 years. But this is a classic example of how compounding works. The power of compounding is backloaded. Thomas Edison has very rightly said that many of life's big failures are people who did not realize how close they were to success when they gave up. So never give up, because you never know when you're going to hit it big in life. So that was basically, how I got started with my portfolio manager job in the US. And, I worked there for 4.5 years. And having, accumulated a decent sum of savings and through investing in the Indian stock markets, I quit that job in July 2021 and started work on obtaining the regulatory licenses for setting up my India Focus Fund in the US. And we launched the fund to the public in middle of 2022 and went live on 3rd October 2022. So that's the story behind how I got to lead Stellar Wealth Partners India Fund in the US.
Wow, that's so amazing to hear, Gautam, because to go from doing graveyard shifts to doing it over 15 months, applying for 1,300 jobs, getting rejected, and then becoming a portfolio manager, and then again leaving that to start your own. So there's so much to unpack there. But tell me about the resilience that was required, and what did you do differently in those 3 interviews? In after that 15 months of rejection that made you land up there. And then what was the final motivation for you to give up on that job and move to like your own fund at that point?
So see, like I mentioned just short while ago, that it's all about passion. Basically, when you are truly passionate about something, that is the inner strength of your passion for investing is what will carry you through the periodic periods of pain and suffering. That is what exactly happened with me as well. Even though I was getting offered many high dollar salary investment banking job interviews, but I did not appear for them. I was very clear. I want to get on the public side, gain experience, and enjoy my work on a daily basis. So that was basically how I got to develop the resilience. It was through sheer passion. If you ask me to do it today, probably I would have a difficult time replicating what I did that time. But I think, again, I was very lucky to land the job that I did, and things eventually worked out pretty well from there.
Yeah. And then here, I think also I would love to understand because, when you're a portfolio manager and that to a US based mutual fund, like you said, then your geography is also, I guess, at that point, US focused, right? But then you chose to focus on India, which is what we were talking about before we started recording as well. Tell me more about, choosing the market and geography because a lot of people in India would assume that, investing in the US is the real deal, whereas, we both disagree with that fundamentally. So would love to go deeper into your thinking about the India opportunity.
I worked as portfolio manager of global equity strategy at Summit Global Investments, where I was tracking global markets with a primary emphasis on the US market. But during the course of those 4.5 years, India as a geography, as a country, as a stock market, very clearly stood out to me in terms of the plethora of high growth opportunities. And I've been investing in the Indian market since late 2007. So I had many years of experience. My heart, soul, and passion always lied in the Indian equity market. So I used to work from 8 a.m. to 5 p.m. every day in the office job, come back home, and then between 7 to 10, I was writing the book. And I was, after writing the book at 10, completing by 10 p.m., I used to start tracking the Indian market. So that passion and drive was always there. It was just a matter of waiting for the right time to build up some credibility in the industry and build up a large pool of savings. Because, when you're leaving behind a well-paying job, you have to, be absolutely certain that, now you can consider yourself financially independent and that you do not need to depend on a regular salary income to take care of all your expenses. So I think once those building blocks are in place, that is when I decided to actually take the leap of faith and start my own India focus fund. And I would not change a single thing of what I do every day now because I truly love what I get to do every day.
Yeah, and then we were also talking about how India has a multitude opportunities, whereas in the US, it's mostly focused around Mag 7. Let's talk about that because I would love for the audience to hear that example that you shared with me.
So one very unique statistic about India, Shrishti, is that if you just look at the last decade, 103 of the BSE 500 companies have become 10 baggers. So one out of every 5 companies in India has given you almost 1,000% return in the last 10 years. No other stock market in the world comes close to this level of wealth creation for investors. So India is a great market for active stock pickers. And unlike the US, where you have just 7 stocks driving bulk of the returns in the S&P and the Nasdaq, here you have hundreds of companies which have got the potential of creating a lot of wealth for yourself and your clients. So no, that stint in Summit Global, what it did for me was it helped me just single down and focus on the one key market that I wanted to concentrate on for the rest of my investing career, which is India. So that clarity of mindset came while I was working for those 4.5 years there.
Hmm. And a lot of people talk about diversification, geographical diversification at that. What do you think about that? What's
It's
your
very, very important because as of end of December 2024, while the US was just 25% of global GDP, but it was 67% of global market cap,
Yeah.
which means that two out of every $3 in the world were invested in the US. So basically, many institutions basically are overly concentrated in one single geography. So now, as US exceptionalism comes to an end and people start diversifying out of the US, I think non-aligned countries like India, especially will be a very big beneficiary. Even if you can get just a few percentage points of that global asset allocation, I think we're in for very, very large FI inflows in India.
Yeah, because I think we make about 3% of the global equities market cap. As someone who sits out of the US and has an India focus, what do you think the US sentiment has been towards this shift which is happening? Because there is, it's there are winds of change in the air where the world order as we knew it is changing. The US is under massive debt, and there are obviously geopolitical tensions all around the world. So there are winds of change, and everything seems to be favoring India. But like as someone who sits there, how do you think the sentiment is changing?
Sentiment is changing rapidly, Shrishti. It just, in fact, in dollar terms, in US dollar terms, the US market has been among the worst performing market this year because many of the foreign currencies like the euro and Japanese yen and Swiss franc, they've appreciated significantly versus the dollar. So the dollar has depreciated significantly against those currencies. Look at the Swiss franc, for example. It's got a 20% appreciation versus the US dollar in the last 12 months.
Hmm.
So, foreign investors are feeling the pinch because in US dollar terms, they're really facing a setback from the USD currency depreciation. That's why sentiment is now shifting rapidly. That's why you're seeing a flow towards emerging markets, precious metals, and non-USD denominated assets. That shift is already underway. So I think we are at the very early stages, and in India being again being a very high growth country will definitely attract capital from global asset allocators going forward.
Yeah, and what are the risks that you foresee? Because sometimes living in India, you also feel like you are feeding into the same echo chambers, and everyone is so bullish about the India opportunity at large. The show also called the India opportunity. So a lot of people will also think that this is a sure shot which is going to happen. But what are the potential risks that you foresee?
Well, Shrishti, one thing I've learned over the last 20 years of investing is that in investing, there's no black or white. Investing is not a deterministic game. It's all about shades of gray. Same thing with India as a country. Nothing is perfect. We have many big risks which lie in the Indian market. For example, geopolitical risk is one of the biggest. Is recently even on the verge of war with one of our neighbors.
Yeah.
And we got a ceasefire, but if that war had prolonged and become something bigger, then you would have seen a flight of foreign capital from the Indian markets.
Yeah.
And one more big risk in the Indian markets, which global investors often think about, is the political stability risk. Right now, you have a stable political regime at the center. But in the past, when you had coalition governments, that time policy and decision making was very, very slow,
Yeah.
and reforms used to happen at a snail's pace. If in the future you have again a very fragmented coalition government at the center, that again may lead to valuation derating for India. So political stability risk and geopolitical risk, these are the two big risks that all the global asset allocators consider when they are looking at India.
Yeah, because it's absolutely crucial as an investor to be very mindful of the risks that you underwrite as well, right? You can be very India focused, but you have to keep these risks in mind because they are very real risks as we just lived through one cycle. But, coming back to some of the timeless principles, because my intention with this podcast, especially sitting with you, was to focus on the timeless principles that you've covered in your books and focus on the real value investing wisdom which a lot of the people who've just entered the markets maybe around the pandemic or after haven't really lived through the pain of losing big chunks of money because what we've seen is a joyride so far, right? Like we have had corrections but 30-40% is still not close to something like you would have lived through during the financial crisis. Let's talk about some of the timeless principles that you think you have benefited the most of in terms of value investing.
Well, there are three timeless principles of value investing, and all three of them have been espoused by Ben Graham in his book, The Intelligent Investor. First principle is to look at every stock as part ownership in a business. A stock is not a ticker symbol flashing on the screen or a price which is just going up and down. You're actually buying a stake in an actual business. So, like Warren Buffett has very rightly said, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. So you have to take an ownership mindset when you're investing in a publicly listed company. You have to look at the valuations, you have to look at the people behind the business, you have to look at the balance sheet, the working capital, the cash flow, all the basic hygiene factors have to be considered before you make the investment. That's the first principle. The second principle is that of Mr. Market. So, you know, the public markets, contrary to private markets, are highly inefficient some of the time. It's efficient most of the time. But there's a sea of difference between saying that the market is efficient most of the time and the market is efficient all the time. There are periods or occasions when value gets completely dislocated from price. Price basically does not reflect value in the business. And Mr. Market is a manic depressive. Sometimes he's very, very joyful, and and the stocks are selling at very expensive valuations. Sometimes Mr. Market is very fearful, and he offers you pieces of ownership in a business at throwaway valuations. So inculcating the patience to patiently wait for the opportunity to present itself is what distinguishes great investors from good investors. Most investors have this urge of doing something all the time.
Yeah.
But this is not a place where where you have to strike at every pitch that is thrown to you. You have to just patiently wait, and just when the right opportunity presents itself, that is when you make a significant allocation. That's the second principle. And third and most important principle is that of margin of safety. When you're buying a piece of a business, do not just buy it at any exorbitant valuation. The price also has to make sense, because a great business is not necessarily a great stock. So you have to distinguish, what is embedded in the current stock price of the company versus what the ideal valuation should be. So that is basically how you make use of these principles and come to a sound investment decision.
Yeah, absolutely. Let's talk about, some examples also, because, while people understand these principles or might have theoretical knowledge about it, but how to apply it in your investing world really makes all the difference, right? So we don't have to take specific names if you're not comfortable, or maybe, if it's in hindsight, you can talk about some examples, but would love to learn about some of the opportunities that you personally tapped into at throwaway valuations, which you might have benefited a lot from.
So I'll talk about a past investment which I had made in June 2022, and this was June 2020, and this was a stock named Rajratan Global Wire. Basically, the business, it was so between 2018-19 and the first half of 2020, the Indian auto industry was in a down cycle, and investors' attention on the entire auto sector was very low. So there was this micro cap company called Rajratan Global Wire, which they basically make bead wire for tires. It's a critical input in the tire making process, and the stock was available at a trailing P multiple of 5 times on depressed earnings. So it was not a case of having a low P multiple on cyclically peak earnings. Here you were getting a company at a P multiple of 5 on depressed earnings, and you could buy as much stock as you wanted, because investors were not interested in to buy any auto or auto related stock at that particular point of time in 2020. And when when the auto cycle recovery eventually took place over the next 2 years, because of earnings growth and valuation re-rating, the stock of Rajratan Global became a 20 bagger for me in just 2 years.
Wow.
So basically, this is a example of applying value investing principles, that you are able to buy a good quality business with a decent balance sheet, good operating cash flow, high insider ownership at a throwaway price. So that's basically how you make the, and multi-baggers, Shrishti, generally take place. The very big multi-baggers generally take place after the bear market, because that is when you get good quality businesses at throwaway valuations. In normal markets, you'll get compounders, but the really big multi-baggers you find only after bear market.
Yeah, I think, Mr. Sanjoy Bhattacharya, who I hosted on the podcast, he was like, I pray for an event like a financial crisis to happen again, so that I can become like really, really rich, right? So a lot of people don't understand this mindset, because they're like, you're an investor in the markets. What will happen to your portfolio if it sees a 70-80% drop? And, do you even have the appetite to be able to live through that kind of a cycle? But what is your mindset now when you're dealing with a bear market? What is your position sizing? How do you think about it? Where do you try to find opportunities? Let's talk about some of the tactical tips that people can actually implement and use.
Sure. So the biggest lessons of investing are always from a bear market, and those lessons bear fruits for a lifetime for all investors. So, in my second book, The Making of a Value Investor, what a bear market talking about investing, I've talked about some timeless lessons which a bear market gives you. The first big lesson which I got to learn from my seniors and colleagues during those 2 years of 2018-19 in India was that India will continue to grow at a steady clip. Nifty stocks may compound their earnings at 10-12%, but there will be a handful of small cap and mid cap stocks which will grow their earnings per share at 25 to 30% for the next 3 to 5 years. They're bound to create wealth for you in the long run. So, what you need to do is you need to have the conviction to back them and then simply wait for the cycle to turn, because just like bear markets are not forever, bull markets are not forever, and these things often just take place in cycles. What you need to do is buy into these high growth companies during a down cycle and then patiently wait for the sentiment to improve. That's basically how you make the big money. The second big learning which I got from my colleagues and seniors in that bear market was sanity will eventually prevail, like it always does after every bear market. In the middle of a bear market or a market crash, when all hope is lost and it seems that nothing will improve ever, that is when you need to look at stock market history and understand that over the last 40 years in India, every fall in hindsight has been a buying opportunity.
Yeah.
So that is the big picture thought which you have to keep in mind. You have to have conviction and belief in India's entrepreneurs, India's business ecosystem. You look at all the big investors of Dalal Street. All of them have got just one single thing in common. They all believe in India as a
Yeah.
country, that whatever happens, India will do well. That is what helps them stay the course through all the ups and downs in the market. That is the thinking we need to inculcate as investors. And basically in bear markets, like we were asking about allocations, because you're able to get good quality business at throwaway prices, at very cheap valuations in a bear market, your portfolio becomes more concentrated with concentrated bets of probably 10-15 stocks only, where you can have 8 to 10% allocations in individual stocks. Because in my second book, I've talked about this, that many investors talk about stocks and buying decisions. Rarely does anyone talk about allocation. But
Yeah.
the great investors, if you see, it was their sizable allocation to their big winners, which made them really rich.
Yeah.
So you do have to. This is something which you get to learn with and appreciate with the passage of time. After your portfolio reaches a certain size, that allocation is what really got me here.
Yes, absolutely. In fact, even Mr. Ramesh Damani, who I had the privilege of hosting, spoke about exactly this, that, he identified a lot of companies right very early on. But the reason he regrets sometimes not taking the big, bold bets or backing up the truck, as he calls it, is because his position sizing was off. And now he's trying to change that, in his life and investing wisdom. But, position sizing and allocation also people don't understand very well. And since you want to talk about it, I would want to go a little deeper in that aspect. Because, a lot of people in especially this kind of market cycle where things are rallying up, like in India also, we are going through a massive bull rally right now, right? Some people are saying that, build your cash reserves and like wait for the cycle to turn, etc. So how does one navigate these kind of cycles or environments where, everything looks like it's on a very positive trajectory? So where is the correction happening? How do you prepare for that to happen? And how much cash should you be holding while you're going through this?
Well, I think, like Mr. Govind Parekh has talked about this in the past. He's a very legendary investor on the last street, and he often talks about the importance of cash and how it gives him bear market buying power. So it's not a bad idea to hold 5 to 10% cash in your personal portfolio or your fund portfolio at all points of time. But as regards position sizing or portfolio allocations, I size individual allocations in my fund portfolio according to my evaluation of potential risk, with the largest positions having the least likelihood of permanent loss of capital, coupled with above average return potential. I initiate new positions with a weight between 3 to 5%, and sometimes the exceptional opportunities may get a weight of even up to 10% at cost in the beginning. And I then sell down to my sleeping point if a single position becomes a discomfortingly large percentage of my portfolio by value. Because individual position sizing is important not only for its impact on portfolio performance,
Yeah.
but also for one's mental peace of mind.
Absolutely.
I also tend to average upwards if the management executes above my expectations. And one should have higher weights in businesses with high longevity, good growth prospects, and prudent capital allocation. As May West has very aptly said, too much of a good thing can be wonderful. So bet big on your best ideas.
And what are the fundamental metrics that you're looking at when, when for the short bets that you're talking about, where, things are definitely on, like, you're betting 10% of your portfolio in that sense. What are some of those metrics that you would be looking at in terms of filtering out?
I'll explain this with the help of an actual case study from my India fund. I think that'll I'll help the audience understand when to really bet big on an opportunity. Generally, these exceptional asymmetric risk reward opportunities arise from such special situations. It can be a demerger, it can be a merger arbitrage, or it can be a management or promoter change. So in March 2023, you had a company named Aarti Pharma Labs, which was spun out from Aarti Industries. And because Aarti Pharma Labs was a pharma company, because it was a small cap company, whereas Aarti Industries was a mid cap and chemical company, what happened was you ended up with forced selling. So basically, all the funds which were mid cap focus, they were not allowed to hold a small cap stock in their fund portfolio. So they started dumping the stock of Aarti Pharma Labs. Similarly, all the chemical oriented funds, because they were not allowed to hold a pharma stock in their funds portfolio, they also started selling at the same time. So shortly after listing, the stock of Aarti Pharma Labs fell more than 40%, and it came down to a trailing P multiple of just 12 times.
Wow.
Whereas there was another group company of the Aarti group called Aarti Drugs that was into more of bulk drugs and commodity pharma. That was trading at a trailing P multiple of 22 times, whereas a more higher quality business, because of forced selling, was available at 12 times trailing earnings. So this did not make any sense. So this was a case of, where I use first principles thinking or the principle of inversion to basically understand what can a stock not be worth. We often talk about what a stock is worth, but if you invert it and just think what a stock cannot be worth, once you've established a floor price for a stock, the upside takes care of itself. So basically, I made that stock of Aarti Pharma Labs the largest position in my India fund with a weight of 8%. The stock has already given more than 250% returns in the last 2 years. So that is basically how you really capitalize on such opportunities.
That's fantastic. Any other examples where you might have started with a smaller allocation, but you got conviction over a period of time to build up there? Like, where you said you started with 3 to 5% and maybe built positions there?
This happened with Bajaj Finance. Basically, it was a stellar outperformer during the small cap, mid cap crash of 2018-19. So I had bought the stock in 2018. And, the management kept on executing well above my expectations. So I kept on adding more and eventually it came to almost 10% allocation in March 2020. But then COVID hit.
Yeah.
And then there was a big crash in the, stock of Bajaj Finance. It fell 65% from the peak.
Yeah, but that's also a company that, Bajaj Finance is like a darling favorite of Dalal Street, right? Like, that's also a company which is often always argued that, it's always richly valued. But I think COVID was the only time where, you could have gotten it at a reasonable
price. Yep.
Yeah. So that was the company that you started buying through COVID and then built on?
I was building on it through 2018, 19 and early 2020. Really, when it started falling after COVID, I did not add to my position. I actually reduced my position by more than half because you want to add to positions when the fundamentals are improving.
Yeah.
Because because it sometimes for things to get clearer and for the fundamentals to improve, it can take a very long period of time also. So you do not want to end up with your capital being stuck, just out of hope.
Yeah.
You have to keep rotating into more higher, better opportunities from time to time.
Yes, let's talk about that aspect also because, while everyone focuses on the buying aspect, I'm also very curious to understand the selling frameworks that people like you have in their minds. So when do you, when in your mind do you think the selling opportunities emerge, or when do you start tapering off the allocations in your portfolio?
There are three big triggers. First one is obviously obnoxious valuations. For example, the moment a stock starts trading at a trailing P of more than 100 times, that means a lot of the future growth is already embedded in the current stock price. So that's a trigger for starting to trim or completely exit a position. Second exit trigger is any corporate governance issue or bad gross capital misallocation by the management. That's also a trigger for an exit, because investing is all about the trajectory of the return on capital employed. Basically, if the margins and the ROC of the business is on an upward trajectory, the company will keep on getting re-rated upwards. But if the ROC and margin are expected to deteriorate or weaken going forward, then you'll experience valuation de-rating. So these two triggers are also there for an exit. And third trigger for an exit, if you find a far superior opportunity compared to what you hold in your current stock portfolio.
Yeah.
These are the three triggers.
Yeah, and you spoke about three major special situation cases, right? Like mergers and acquisitions, or like some transition happening in the promoter management. Any other examples that come to mind where you spotted the opportunity very early on or during this special situation case?
Yes. There are so many. So I'll talk about a merger arbitrage situation. So in late 2022, there was a stock called Equitas Holding. Basically, the Equitas Holding and Equitas Small Finance Bank were about to get merged together, and there was a merger arbitrage discount of, for certain number of shares of Equitas Holding, you would get a certain number of shares of Equitas Small Finance Bank. And at that particular point of time, based on the stock price of both the companies, there was a 15% merger arbitrage on the table. The merger would get completed in the next 6 months. At the same time, the banking industry was undergoing a tailwind and undergoing an upcycle. And the stock of Equita Small Finance Bank was also available at a very cheap valuation of just 1.5 times price to book. So all the elements were there in place for you to to invest in Equitas Holding and the holding company, which was going to get merged. So you get upside from the merger arbitrage discount. You get upside from the banking industry tailwind. You also get upside from the potential valuation re-rating of the underlying business, which is getting merged, which is Equita Small Finance Bank. So when you're investing in these merger arbitrage situations, you have to have a favorable view on the underlying business, the primary business which is underlying. So basically, that is when these merger arbitrage investments turn out to be very, very profitable. So the next special situation I would like to talk about is that of promoter or management change. So there you get potential big multi-baggers. So a few years ago, the Murugappa group basically took over CG Power at, I think, 12-13 rupees per share, and that stock went up more than 50 times in just a few years time from there. So when you're investing in promoter or management change situations, the ideal situation is one where the underlying business is of a good quality or the underlying asset is of a good quality, but it's being badly mismanaged, or just, there's a lot of low hanging fruit in terms of low margins or inefficiencies, which the new promoter can basically take care of and start. That is when you get the delta or the big percentage changes in your profitability. That is how you get the big multi-baggers in promoter management change situation. The big multi-baggers do not take place when the promoter management change is happening in a business which is already being run very well. The big multi-baggers take place when the business being acquired was not being managed properly, because investing is all about delta, the rate of change. That's what we need to focus on.
Any other examples, like when it comes to rate of change, applying rate of change to your core investment philosophy? Because, there are so many businesses, like in this mergers and acquisitions case also, there might be delays that might happen. A merger might not happen in the foreseen time that it was decided to happen at. Or like the person who's coming in charge in terms of a promoter change which is happening, they might not execute as well as one would hope, right? So there are things that can still go wrong even if you find like a ripe opportunity and it doesn't turn out the same way. So how do you notice these rate of change opportunities, and then also where are you discovering some of them? Because while in hindsight I can know like all these opportunities were there, but how do you find it while before it's about to happen?
I'll talk about, you mentioned that some cases do go wrong. So we have got many examples of, these things going wrong as well. So for example, India Bulls Real Estate is a prime example. And the Embassy Group was going to take over India Bulls Real Estate, and there was going to be a merger. It took a long time for that particular thing to happen.
In fact, that was the example I was thinking about in my mind also, but yeah.
Yeah, so basically, so that's why, when you are investing in these special situations, you should be aware of the base rates of success or potential for delays or some mishaps happening. That's why you diversify. You do not just place all your bets in one single company. You basically diversify your bets, and when do you understand when to bet big? Or no, you basically bet big, when in case of merger arbitrage situations, for example, if the business being merged is not of strategic national importance, for example, if it does not belong to telecom or defense, there's a reasonable chance that the merger will go through. So you basically, size your bets accordingly. And if the incoming promoter or the new promoter has got a very solid, strong, established track record of wealth creation, for example, the Murugappa Group I mentioned, that is when you gain much more confidence that, the chances of them not being able to execute is very low. So that again influences your position sizing. So I think, I always prefer takeovers by promoter groups rather than takeovers by private equity, because private equity in many cases are very short term. They are basically trying to take over a business, turn it around, and then flip them to the next buyer. Whereas promoter or family groups have got a much more longer term mindset when they're taking over a business. So those are the situations I prefer.
Okay. And, here I think we can also talk about some of the frameworks that, might have evolved for you over a period of time because, like we said, that, every value investor has their own journey. So, what has your personal journey been in terms of evolution? What are you doing differently today than the Gautam, like maybe 20 years ago?
So my investment philosophy has significantly evolved over the last 2 decades with time and experience in the markets. Initially, I started off by reading The Intelligent Investor by Ben Graham. So I started off by investing in low price to earning, low price to book stocks. Then I read about Warren Buffett, Charlie Munger, Phil Fisher, and I gravitated towards quality stocks at reasonable price. But today, my investments, cover multiple aspects of the investment universe, including cyclicals, commodities, special situations like demergers, management change, and merger arbitrage. Because no single strategy works all of the time and in every kind of market.
Yeah.
And to be able to generate alpha for yourself and your clients, you need to be able to hunt from within different areas in the market. And over the years, I've come to realize just why this is so critically important. It's because there is always a bull market taking place at all points of time in some specific sectors of the stock market. So you need to have a broader value approach to be able to participate in these, cyclical tailwinds in different industries from time to time.
Yeah, like Mr. Manish Chokhani, who we both know, said on the show that, it's a great cycle for hard assets. So anything with hard assets will keep going up and we'll see the rally across. What are some of the things that you are personally very bullish about or which you think are not very contrarian and not fully discovered yet?
I think precious metals is one which is not being talked about too much in the current stock market, but I think gold is fast taking, cementing its place as a neutral reserve asset. As people try to diversify out of the dollar and into gold, I think gold financiers in India, especially, I think they are in for a very good time ahead. So,
Yeah.
that is one spot which is less talked about right now, but I think there's got a lot of potential going forward. And the other themes, like honestly, in India, most of the good themes are already well discovered and well talked about in the media. So
Yeah.
you have got financialization of savings, branded discretionary consumption. You have got AI, AI plays like power ancillaries, data centers. You have a very big trend which is taking place in the world in the form of weight loss drugs or GLP-1 drugs. So you have a few listed companies to take advantage of that particular mega trend as well. And with so many geopolitical tensions taking place in the world, defense, for the first time is looking like a decadal opportunity because now the US wants not only the European allies, but the Asian allies to also up their spending on defense to 5% of GDP.
Yeah.
So, like I mentioned, investing is all about catching the next big trend. So, these three trends, AI, power, and defense, I think are poised to create a lot of wealth along with gold financiers.
I would love to go deep into all three that you talk about because defense, has seen a significant rally, right? And some people would argue that, we've already lived through the rally because we did go from like just $1 billion in market cap to now where we are suddenly. And, Mr. Ramesh Damani also, he's been very bullish about the whole defense sector. And he was on TV talking about this opportunity even 5, 6 years ago. But now a lot of people feel that the theme is already played out, especially after the war and the budget announcements. People think that that theme has already seen a massive rally. So where is your head at currently?
Basically, every 100 bagger first became a 10x and then went another 10x from there. So, even though, many of these stocks have become 10x, we have to just focus on, what lies ahead. So investing is a probabilistic bet on what lies ahead in the future. There's no point looking in the rear view mirror and investing. Many, of the biggest winners in the biggest winners in the stock market always tend to look expensive because, they tend to hit their all-time highs just after a market correction or after a bear market. That's why many investors shy away from them. But the collective wisdom of the market is far bigger than any one single individual. If the market is telling you that this is where the money flow is going, all the smart money is flowing, then we have to respect the wisdom of the market and also try to study deeper instead of just shallow statements like this has gone up so much so it can go up more. We should have to focus on where the thrust of the government is because after COVID, governments across the world over have become very powerful. They are dictating where the flow of money is going, both from public side as well as private side.
Yeah.
So if the thrust of the government is on emboldening defense in the country, who are we to fight the mega trend? I think it's better to be on the right side of the big trend rather than try to fight trends in the market. That's basic. You don't want headwinds. You want to invest in businesses with tailwinds and the blessings of the government, and that is how you make the big money in the market. So I think avoid any anchoring bias. Because you'll never, many investors who have seen low prices in the past, they're unable to buy the same stock at a higher price in the future because they become anchored to the low price of the past. But you cannot buy today's stock at yesterday's price. You have to look at the current valuation and whether the growth prospects of the next 5 years justify you making the investment or not.
Yeah, I think you're referring to a personal conflict that even I have because, I bought into some defense companies, but at the current prices, even then, I would be breaking my personal frameworks of like, what the fundamental metrics should look like, right? And I think because you're also a value investor, let me ask you this, then are you breaking your discipline in terms of, ignoring some of the metrics when you find such high rate of change opportunities in that sense?
So, one key investing principle which many investors misunderstand in today's world is that they mistake value investing for valuation investing and they end up investing in value traps. So, that is what you want to avoid. Value investing is not about cheap valuation companies, it's about getting more value for the price being paid with the lowest amount of risk. That is what actual value investing means.
Yeah.
And when you talked about, are you breaking up principles? No. So, basically, how do you determine the margin of safety for an investment? Here I'll refer to two white papers for your audience. The first white paper is titled What Does the Price to Earning Multiple Mean by Michael Mauboussin. The second white paper is called The P Ratio, a User's Manual by Epoch Investment Partners. Once you read these two white papers, you can arrive at the fair or justified P multiple for any listed business in the world because you'll realize that the justified P multiple for any business is determined by an interplay of return on invested capital and the expected growth of the business. So, if you're able to buy a stock at less than the justified P multiple, then over time you benefit from the earnings growth plus some valuation re-rating. But if you buy a stock at way above the justified P multiple based on this interplay of these two factors, then over time you will get some returns from earnings growth, but you may have some valuation de-rating. So that will neutralize your investment. So the trick here is to buy stocks at at or below the justified P multiple, and then just wait. And from my experience of the last 20 years, Shrishti, in the Indian market, I've realized that as long as the company is growing very fast, the valuations don't come down. The valuation goes from reasonable to expensive to super expensive to absurdly expensive.
Yeah.
And then once the growth starts decelerating sharply, again, when does the valuation de-rating happen in a stock here? If the deceleration or slowdown in growth is gradual and slow paced, then the valuation de-rating will also be gradual. But if a company which is growing at 35-40% suddenly says that it's going to grow at 15-20% only, then the valuation de-rating is rapid.
Yeah.
And you end up with, you can end up with permanent loss of capital. So the trick is to distinguish about, the pace of, earnings growth deceleration. That will help you time your exits properly.
Yes, I think this is great advice because, a lot of the times, even in our comments, we often read that, people are talking about themes which have already played out and, how can you invest in defense now, etc. Because this was a common debate which is happening in the comment section after Mr. Ramesh Damani's episode because everyone was like, this is already richly valued. So you're not talking about something that we can actually benefit from. But, what you're saying gives people a way to think about these things very differently and apply it in their lives. But also talking about power and AI as the themes, very curious to hear your take on both because Mr. Sanjay Bakshi, Pandu professor, he spoke about how power and, India can't benefit, India can't grow without fossil fuels, right? And he thinks that, that is a sector which is really, really underestimated right now and will perform really well. What are your thoughts broadly around
I
that?
think one good way to play the AI boom is, you have to understand, the ancillary plays or, what are the proxy plays to play this, the pick and shovels like we call them. So, power ancillaries like transmission and distribution, gen- generation companies, and also AI, data centers consume a lot of water. So, water treatment, capital good companies, they are another, way to participate in the AI boom. So, basically, what's going to happen in this particular industry is AI ultimately will become very commoditized, and you will see a lot of lower margins among the the primary AI players, but the ancillary companies or the ones who provide the picks and shovels to these industries, that is where you can see a lot of growth. So data centers, power ancillaries, also these water treatment or water related companies. I think that is also where you'll see a lot of growth in the AI space.
So, would you be investing in those companies right now? Like, are there any sectors that emerge specifically for you?
So in our Stellar Wealth Partners India Fund and in Complete Circle Stellar Wealth PMS, we have invested in transmission and distribution plays, and we have also invested in a few water treatment companies. I think these two sectors will have a lot of growth ahead of them because of the sheer growth in AI infrastructure being put across the world. I think next decade looks very, very promising. They are fairly valued on a current year basis, but if you simply take a long term view, I think the returns from year 2 to year 5, they can compensate you for the low returns in year 1. I think that is again, this is time arbitrage.
Yeah.
When you take a long term approach, basically many investors just focus on the next quarter or 2 quarters. You simply elongate your time horizon and have patience. The returns from year 2 to year 5 compensate you handsomely for the low returns in year 1. But that's something which most investors are not willing to put up with because everyone is caught up in instant gratification.
Yeah.
So
And gamification of the trading apps has made it even worse, right? Because on like a swipe of a phone, you can buy any company or exit any company. So it just makes it so much harder to be long term, truly long term. So like going back to that, like also in terms of idea discovery, there are sources like value picker, etc., that one looks up to. But what have your sources of ideas been so far? Like, where are some of the best ideas coming from? Is it a lot of inner work, reading, all of that, or is it through interactions with peers, etc.?
it's a very exhaustive list, and I would like to share some of the items from the list with your audience.
Sure.
So every single, starting with BSC corporate announcements. So every single day, I go through all the filings on the Bombay Stock Exchange and look for potential new developments and sources of ideas. So I go through the M&A deals, joint venture announcements, any corporate announcement about any expansion. For many investors, it's a very tedious, boring task, but for me, it's like an intellectual treasure hunt wherein I may strike gold at any point of time. I also go through the press releases, investor presentations, annual reports of companies, the conference call transcripts of companies. I also go through to develop industry level knowledge. I also go through draft red herring prospectuses. Initiating coverage reports of companies are another great source for getting industry level information. A less talked about but very good source for idea generation is going through the top 5 holdings of fund managers on PMS Bazaar website. The login on the website is free.
Yeah.
And once you log in, you can actually go through the top holdings of fund managers whose investment philosophy you like and admire and respect. That's another good source. You can also use screening tools like Tijori Finance, Screener.in. That's another good source. You have forums like Value Picker where you can have a lot of idea generation taking place. Daily interactions with peers and colleagues in the industry is another good source. Go through management interviews in print and digital media. That's also another good source for idea generation. So there's a plethora of sources, and if you go through so many resources on a daily basis throughout your career, how can you not be simply flooded with good opportunities all the time, be it a bull market or a bear market? In life, business, relationships, or investing, nothing will work. Nothing will work unless you do.
Yeah.
And there is no reason for anyone to settle for an inferior track record in a marketplace like India, which is filled with companies having great fundamentals. Just the person who turns over the most rocks wins the game, like Peter Lynch has said. So just turn over as many rocks as you can, and eventually you'll come across a great opportunity.
That's amazing. And that's a very exhaustive list that you've given our audience. But how much time do you spend doing that? Because it does take a lot of work to be able to go through all of the exhaustive lists that you just shared. So how much time do you spend inculcating this on a regular basis?
7 to 8 hours on the weekdays, daily
Wow.
basis, yes.
Amazing. No wonder you have such great ideas and obviously a lot of rich information that, floods your head and always prepped with ideas. But then how often do you act in terms of making investing decisions? Because, as a great investor, you don't need to act very often. You need to act a few times, but get it right. Like, Warren Buffett famously says that, he must have had like out of his entire career, maybe 12 investment decisions that he got right. How do you think of making the bets when you do that?
The idea behind doing all this exhaustive research every day, Shrishti, is not to actually necessarily act or buy a new stock. It's to build up a bench or or a watch list of great ideas. Basically, what happens in India is sometimes some adverse industry level development takes place. Sometimes a promoter related development takes place. Something or the other goes wrong in some or the other company you're investing in. So it's very important to be ready with a watch list of great opportunities, which you can basically recycle the capital into. That's the whole idea behind doing all this research on a daily basis. I want to have 10 to 15 high potential opportunities ready with me on a regular basis at all points of time. So that, in case I need to sell a certain stock from my fund portfolio or the PMS portfolio, then at least, I have a ready replacement with me.
Hmm. And then, also applying this from your book in terms of joys of compounding, how does your personal portfolio differ from your PMS portfolio?
So managing public money, for a fund or a PMS is vastly different from managing money in your personal brokerage account, because when you're managing public money, you have to pay attention to two key things. The quality of the business that you're investing in, that is non-negotiable when you're managing public money. The second big thing you have to focus on when you're managing public money is that you have to also look at the trading volume liquidity. In your personal capacity, you can invest in illiquid macro caps also. But what happens when you're managing public money is you have to also look at whether the stock is liquid enough, so that if in case something goes wrong, you're able to at least exit that position for the clients. So these two things you have to focus on. A third, most important, if you're looking to build a enduring investment enterprise over the long run, the process which you follow has to be replicable, repeatable, and scalable. You have to, if you basically want to leave behind a legacy, you want to focus on something which is easily replicable. So that these are the three things: the process, the trading volume liquidity, and the quality of the business that you're investing in. These are the three differentiators for you.
So after all these years, what is your process now?
Process is very well defined now, Shrishti. So basically, at Stellar Wealth Partners India Fund and at Complete Circle Stellar Wealth PMS, the investment philosophy is built on two key pillars. First one is variant perception. Second one is long-term structural trends. Variant perception is it basically refers to situations where you get earnings growth along with return on capital employed (ROC) expansion. That leads to valuation re-rating, and you can end up with multi-baggers. And there are basically, variant perception comes from having a differentiated view on the short to medium term trajectory of a business. There are multiple catalysts of variant perception. Number one, product mix change into a high margin category. So what happens in this, if a company is venturing more into value added products and margins expand, then net profit grows at a faster pace than revenue growth. That's the first. Second, there's operating leverage, which can come from having high unutilized capacity just at the beginning of an industry upcycle. Third one is deleveraging. As debt goes down, interest cost goes down, net profit goes up, market cap goes up. Also, because debt is a part of capital employed, as debt goes down, your return on capital employed automatically goes up.
Yeah.
Fourth, variant perception catalyst, industry cycle shift. As an example, since middle of 2020, the residential real estate cycle in India turned around, and we had many multi-baggers from the real estate and building material space. Fifth, government regulation. So basically, any favorable regulation from a regulatory body, that can also be a catalyst for multi-baggers. So in March 2020 to 22, the RBI relaxed the norms for microfinance companies, and many microfinance companies became multi-baggers from there. Sixth, variant perception trigger is improvement in asset turns. Basically, there are two sources for ROC expansion. One is improvement in asset turns. Second is margin improvement. And between the two, I prefer the former because high margins tend to attract competition. You can get this information from management on conference calls. What is the expected turnover on the fixed asset capacity? And then you can make a decision accordingly. Seventh trigger for variant perception, working capital improvement. Basically, if the company is able to negotiate better terms of trade with its suppliers and customers, then the working capital cycle gets shortened. And because working capital is a part of capital employed, your ROC expands, and there also you get valuation re-rating. Eighth trigger for variant perception, corporate actions like demergers, promoter management change, merger arbitrage, and divestiture of a loss-making or non-core business unit. Four additional triggers. So you have many triggers for variant perception. Now let's talk about long-term structural trends. That is where we concentrate the bulk of our portfolio. Long-term structural trends are found in industries with a very favorable structure. They're organized like a monopoly or a duopoly or an oligopoly at best, and they are characterized by some form of an industry tailwind. They have consistency and predictability of cash flows, so you can have visibility for many years ahead. They are also characterized by value migration. So in India, for the last 30 years, we have had value migration from public to private, unorganized sector to organized sector. And there are multiple structural growth plays in the Indian market which is available today, including financialization of savings, the GLP-1 drugs, defense. You have the artificial intelligence AI related plays. You have housing finance companies, gold financiers. Multiple structural growth plays are available. So basically, in our fund in PMS, what we do is we have 70-80% of the fund, these long-term compounders, structural growth plays, and 20-30% of the portfolio is in these variant perception tactical plays to generate alpha for clients.
Gautam, I think that's a very good exhaustive list of frameworks for people to think about when choosing which sectors to apply to invest in. But let's also talk about the sectors that you won't touch or you don't think are investable, but might be very hyped up in the media or might be the talk of the town right now, but you don't see the long-term future or prospects there.
Well, investing is always bottom up. So, even though I mentioned defense a short while ago, but there are many defense companies with very large order books, but history of very patchy or bad execution. So, you do not want to just, invest in a company just because it belongs to a hot theme or hot sector. You have to evaluate the business bottom up. At the same time, avoid commoditized sectors where competition is intense, because competition acts as friction for value creation. That's the mantra for good, investing. So, Warren Buffett has often taught us that the key to investing success is is not how fast an industry is going to grow. It's about assessing the competitive advantage of individual businesses within the value chain of a particular industry, and investing in businesses where there is supply side dominance or dominant market share. Why is that so important? Is because after every passing industry crisis, these strong players capture market share from their weakened competitors, and this market share capture is a source of great shareholder value creation over time. So you want to invest in businesses which are having a kind of a monopoly in the industry. For example, aviation previously was non-investable, but now you just have effectively just one single player which is ruling the show in the Indian aviation industry. So now that has become very attractive. This is not a stock recommendation, but just to illustrate that you want to move your capital to industries which are becoming more consolidated from fragmented. So basically, commodity industries or highly competitive industries, businesses which require a lot of capital guzzlers, those industries also you can avoid. And deeply cyclical industries and companies is also something that long-term investors should ideally avoid.
Can you give us some more real examples? Companies, not companies, but like sectors that you wouldn't want to go deeper into?
For example, sugar and tea, for example. Then we have many listed stocks from both these spaces, but they are subject to so much government regulation and control that you cannot really make sustainable wealth from these two sectors, sugar and tea stocks, for example. And then, again, metal stocks, for example, are deeply cyclical. So, and they will look cheap, optically cheap on a price to earning basis when they're enjoying cyclically peak earnings. But that's the worst time to invest in such kind of companies. You want to basically invest in those deep cyclicals during the industry down cycle, after checking the company's balance sheet, whether the debt is manageable, and if the company is generating decent operating cash flow even in a down cycle. And those are the kind of companies you want to back with your capital. But most of the time, the investors enter these deep cyclicals just at the peak of an industry upcycle, because they extrapolate, because of recency bias, the recent high profitability in margins into the future, and that is when permanent loss of capital takes place. So deep cyclicals, commodities, illiquid macro caps with no track record of execution, and commoditized industries, I think these are the areas where you basically want to avoid putting your client's capital, because investing is a negative art. Knowing what not to do is far more important than knowing what to do. You basically, so Warren Buffett, again, I'll quote him again here, because he's got so many gems on investing. So he says that there are no brownie points for extra levels of difficulty in investing. You don't. This is not this is not a Olympic game, right?
Yeah.
You want to basically step over 1 foot hurdles rather than 7 foot hurdles. But because so many of in the finance world come from very good academic backgrounds, and we are so intellectual, we just get into a intellectual ego fight when we're investing in a business. We want to solve complex problems. We want to get into complex investment situations and then try to make money off them to feel good about ourselves. But if you see, the great investors are the one who embrace simplicity, both as a way of life and in their investment decisions. The lesser number of moving parts that you have to deal with in an investment situation, the better off you will be in the long run, because that reduces the chance for unforced errors. The more decisions you have to make, the more the chances of errors. So you want to basically get into as many long term opportunities as you can, and avoid this statistically cheap low quality stocks, because you have to keep recycling them again and again in a short span of time.
Yes, absolutely. And I think that's a fantastic example that you gave also, because, there are lots of people who just read Warren Buffett's quotes, etc., and think that they can apply them and appreciate them. But then the same people will also then go and do a lot of SME investing, or like, investing in pre-IPO stocks, or in the unlisted space, or like, IPOs specifically. So what do you think about that kind of behavior? Because in India, we also seeing a frenzy in IPO opportunities. Yesterday only I posted about how India is experiencing an IPO boom, where I think in 2025 2024, there were 327 IPOs that happened in India, which was globally number one. And, everyone talks about how in India there's not enough capital movement, but, whereas in the US it was 33 billion or so, India was very close to it, like 20 billion dollars in terms of market movement. So, that's a big shift which is happening in India. There's a lot of frenzy around IPOs. How do you think of situations like that?
This again comes back to my point about people preferring more complex situations or exciting situations over the obvious.
Yeah.
So I'll give a simple example here. So the IPO of HDB Financial is about to hit the market very soon.
Yeah.
And the price band which is being talked about is already at a significant discount to what the stock is trading in the unlisted market.
Almost 70%
So
discount,
a
right?
very big discount,
Yeah.
right? So basically, the unlisted market is fraught with such dangers. The IPO may get either called off, or it may get listed at a far lower valuation than which we have invested in the private markets.
Yeah.
And when you're investing in the private markets, you generally don't get an absolute bargain of a deal, which you can get periodically in the public markets. It's a far more easier game, in my view, to play. So and instead of making life much more unnecessarily complex for yourself, I think it's much more easier to play on the public market game than the private market game. And the word which you use, frenzy.
Yeah.
We value investors are very wary and cautious of that particular term. Wherever there's frenzy in a particular theme or sector, that means a lot of capital is flowing into that particular industry. What does that signify? Increased competition, and increased capital leads to lower returns on capital over time.
Yeah.
That's a recipe for valuation de-rating because more competition is coming in the industry. So you want to basically go into places where capital is flowing out of the industry and the industry is becoming more consolidated rather than where there is frenzy in a particular sector. So you just have to be very careful.
In fact, this I can apply to even what's happening in the AI world in the private space, right? A lot of money is flooding into consumer applications or, the applications as is in today's time period, but a lot of them will get easily replaced because the advancements that we are seeing in AI will not, benefit these companies which might currently be benefiting from the situation. Whereas the picks and shovels approach that you spoke about, those are no-brainers. But, I don't see enough capital going there versus, all the capital is getting flooded into some of these hype companies, which sometimes don't have a business model or revenue model or don't even know when they'll monetize, but the capital is just driving the growth, right? So, in private versus public, because, I have that lens of being privy to what happens in the private space also, I feel like a lot of misallocation of capital is happening just following this AI hype cycle.
Right, absolutely correct. Because these picks and shovel plays are not glamorous enough.
Yeah.
People always want the hot, glamorous next big thing. That's why they get attracted to such plays. But I think investing by nature is very boring endeavor. Boring is good in investing, in my view.
Yes, absolutely. And, coming back to your book, because I think we both bonded over how some of the life principles that we share are very identical to what we've covered in the book. I would love for you to share some deep insights with the audience in terms of how they can enrich their lives by applying some of the lessons that you talk about.
Especially the core lessons of the key essence of the joys of compounding is that the best investment you can make is an investment in yourself. In the first chapter of the book, I state that today, after having successfully achieved financial independence through my passionate pursuit of lifelong learning, I can happily say that I'm a better investor because I'm a lifelong learner, and I'm a better lifelong learner because I'm an investor. So, at the same time, the lessons in the book are not restricted to only about money. This is because, compounding does not apply only to money. Social and intellectual capital also compound. Investing in yourself, in your relationships, and in your understanding of the world pays massive dividends over time. This is the big message I want readers to take away from the book, that just don't focus on one aspect of your life. Have a holistic approach to various aspects of your life. That is, how you live a very existence of fulfillment and happiness.
Yes, absolutely. And you also spoke about good karma and, how much love and affection you are receiving as an author now, that you didn't envision that, would come your way. But obviously, compounding has reaped its rewards even for you. So, because you're such a living embodiment of compounding, I would love for you to share with our audience some of those examples which, have really meant a lot to you after becoming a published author.
So, you mentioned two very important words, good karma. So, I'll elaborate a bit on them because I'm a very firm believer in this, the power of compounding goodwill. So, in my view, Shrishti, good karma simply, I'll simplify it for everyone. Good karma simply means being a nice and helpful person and helping others unconditionally. So, I have benefited greatly from this particular practice in my life, and I'll share two personal examples, with you. So let's talk, the first person I would like to refer to is a person named Sean Idings. He's basically the co-founder of the Intelligent Fanatics project in the US in the macro cap space. And by 2018, I had basically built up a decent following on Twitter. Sean Idings, my colleague, had a small following, so I used to quote tweet him a lot, retweet his content, share helpful articles with him from time to time. And in late 2000, in April 2019, Sean sent me a DM on Twitter saying that, Gautam, me and Ian Castle, another big name in the macro cap investing space in the US, we both were scheduled to have our book signing at Creighton University in Omaha during the Berkshire Hathaway meeting next month. But due to some last minute, issue, we are unable to make it. Would you like to take our place at the table at Creighton University? So then, basically, he introduced me to Jim Ross. Jim Ross is the manager of the Omaha Airport Bookstore, and he's the organizer of that book signing event at Creighton University. So, basically, I got in touch with him. I shipped the books there. And, basically, this was one simple example of, how just, helping someone in the past, basically, ended up, helping you in the future as well. The second example I'll give is, from, the self-published edition of the Joys of Compounding. So in late 2018, I sent the manuscript of the Joys of Compounding to two publishing houses in the UK. Both of them came back to me with the feedback that, Gautam, you're trying to be too bold, too over ambitious. You're trying to do too many things with one single book as a first time author. You should just play safe by going with this conventional route of, just writing a simple book on investing principles. But I was very firm and adamant that I have got very high conviction in my body of work, and I'm going to publish it as it is. So I ended up self-publishing the Joys of Compounding, and I sold that self-published edition for zero royalty. I paid for the entire costs of marketing, production, and distribution from my own pocket. At that particular point of time, the only idea was to help as many people as possible and to give back to the investing community, from whom I have gotten to learn so much over the years. And I thought, okay, I'll maybe attract a few like-minded people into my investing circle. And even if the book sells a few hundred copies, and influences some people positively, the book will be worth the effort. Never did I imagine that the book would sell. The self-published book would sell so well in US and Canada. Now let's come back to May 2019. So Jim Ross, the Omaha Airport bookstore guy and the organizer of the Creighton University event, he called up Miles Thompson of Columbia Business School Publishing in New York, saying that, Miles, you have to fly down here to Omaha. There's something special happening here. There's this author I've never heard of before, but his book is flying off the shelves. You have to come and meet this guy. So Miles Thompson flew from New York to Omaha to meet me at Creighton University and offered me a publishing opportunity with Columbia there instead.
That's
So I went speechless and numb for a few minutes, unable to digest the magnitude of what had exactly happened.
yeah.
This is one more example. So when I sold that book for zero royalty, that time I had no idea. I didn't know that that the book will sell so well in US, Canada, and that I will get an opportunity from Columbia. But again, this comes back to the point that when you help others unconditionally, the universe works in such a way so as to come back and reward you back multiple times over.
Yeah.
And this is just two instances. There are so many examples from my life that I believe now that this is the way to live a very happy and fulfilling life. This is the way to go.
Absolutely. And you also spoke about stoicism and we connected over gratitude as well. How
I
has
love that word.
how has that helped you in your life?
Gratitude is the most effective way to find contentment. That's basically, there's a section on compounding positive thoughts and the joys of compounding, where I've talked extensively about the importance of gratitude because, in whether you're in any position in life, any situation in life, there's always something to feel grateful about. So in the US, and India as well, basically every day I have what I call a gratitude journal. There are basically three sections which I fill up every morning, and there are two sections which I fill up every night in that gratitude journal on a daily basis. The first section in that gratitude journal is three things that I'm grateful for today. Basically, and then the second section is what would make today great, and the third section is two positive affirmations. So basically, every day I make two positive affirmations to myself. And at night, basically, there are two sections. Three good things that happened today, and what are the two things that I learned today. So when you do this practice for the rest of your life, and when you refer back to your gratitude journal, you'll end up feeling grateful for so many things that you take for granted on a daily basis.
Yeah.
When you see what's happening around you and around the world, there are hundreds of things to be grateful about on a daily basis, and that just keeps you very happy. as a
Yes.
person.
Even just waking up every day, or being able to land after a flight, like after the recent incident, such things that we take for granted on a daily basis, which is why I have the reminder that I do on my arm. But, we've spoken a lot about your experience with, the fund, sorry, we've spoken a lot about your external Western influences like Warren Buffett, Charlie Munger on your investment philosophy. But can you take some examples closer to home of like Indian investors who you personally admire and who you've looked up to as mentors?
So there are so many, Mr. Ramdev Agarwal, Mr. Ramesh Damani, Mr. Utpal Seth from Red Enterprises, Mr. Manish Chokhani. There are and Mr. Sanjay Bhattacharya, who you had on your show in the past. There are so many great investors to learn from, and all of them, many of them have got very different investing styles, but the end result was, a great success. So this again brought out to me the fact that there is no one single route to heaven in the stock market. There are multiple roadways to heaven here. So, don't get boxed into one single style. You can basically keep evolving over time and, just keep learning from everyone. I think, it's very important to learn from, other people's successes, but even more important to learn from other people's mistakes. So, how do you do that? You can basically look at books, experiences, people, everything can be a learning opportunity when you have the right mindset. So if I talk about books, you can read books like Big Mistakes by Michael Batnick. You can read books like Confessions of a Stock Market Wizards by Safir Anand. You can even read my second book, The Making of a Value Investor, which what a bear market taught me about investing, in which I've talked about the multitude of mistakes I made during the bull market of 2014 to 2017, which came to bite me in the bear market of 2018-19. That's about books. Now, vicariously learning from the experiences of other investors is another very good technique to learn from other people's mistakes. So you've got all these investors, for example, Sanjay Bhattacharya often talks about how he sold Asian Paints too early.
Yes.
Then, Ramdev Agarwal also talks about a few of his mistakes. Mr. Ramesh Damani talks about not allocating enough to a great opportunity. There's enough, experiences to learn from if you're just a humble person. And humility is the key to, lifelong learning. Without embracing a sense of humility, you will not be able to succeed in this endeavor, because when you look at all the great investors and the kind of mistakes, I mean, if Rakesh Jhunwala has got a Titan and a Lupin and a Crisil, he also has a Diwan housing and a to Z infra or other duds as well. So these things just keep your mind in perspective and keep you humble, and you just want to keep this stock market is the ultimate humbling machine, Shrishti, in my view. I mean, if you're not humble, then be ready to be humbled sometime in the future.
Yes, in fact, it's so funny that you mentioned some of these names because I've had the privilege of hosting a few of them on the show. And the more I meet people like those, the more I appreciate how humble they are. Because, you might meet people who've been investing for 3 to 5 years and they are so confident about, whatever their portfolio allocation is. Whereas when you meet these kind of greats and the legends of the Lal Street, then you truly appreciate how humble they are, how grounded they are, and maybe that's the reason why they are successful as they are, because it truly takes being humble to get you very far in life, especially if you truly value the joys of compounding and things like that, right? And living through those timeless principles.
Absolutely, because those investors, like which you mentioned, they've lived through multiple market cycles.
Yeah.
They are not the post-COVID investors who have just seen an upcycle with periodic corrections. They've actually been through bear markets which have lasted for multiple years. So they are the market has basically told them that there's the good times do not last forever, neither do the bad times last forever. So they are able to keep their mind in perspective and just appreciate what the market gives them.
Yeah, and who's had the most profound influence on your investing style?
There are three, very big influences on my investing style. The first one is Joel Greenblatt. He wrote a book called "You Can Be a Stock Market Genius," which focuses specifically on special situations. That gave me a lot of expertise in investing in spin-offs, merger arbitrage, and other special situations. The second investor who had a very big impact was Terry Smith. He wrote a book called "Investing for Growth." That taught me how to invest in high quality businesses for long-term wealth creation. And the third influence was from a person named Edward Chancellor. He edited a book called Capital Returns, which taught me how to utilize the capital cycle theory and invest in cyclical businesses for tactical alpha generation. So,
In fact, I'm reading that right now, and he talks about consolidation, especially after market cycles, etc. And I love that insight that you shared about aviation because it clearly matches that example, and that's what I was also thinking about when you were talking about it. When I found it really special that your tagline for the fund is generating generational wealth for investors. What does that line mean to you?
Generational wealth basically, means that you are investing in a very sustainable, long-term manner without paying too much, without paying too much heed to the short run, and you are basically leaving behind a legacy for your next generations to take over. Basically, you are building something which is sustainable, replicable, repeatable, and which is not just short-term, fleeting in nature. I think that is what generational wealth basically means. Most investors, we were talking about this before the show, that many of the successful investors on Dalal Street multiplied their money initially in cyclicals and commodities and special situations, and later on they compounded in quality. So I think that is basically how generational wealth is created over time in the stock market.
More power to you on that mission, Gautam. And I think you are doing a tremendous job. And thank you so much for coming here today and sharing these timeless principles and frameworks, because I think whatever you've shared is actually very, very tactical, and people can actually implement it in their daily investing lives, and also broadly in their broadly in their lives as well. So thank you so much for taking time out to be with me here today.
Thank you so much, Shrishti. This was fun. Thank you.
Awesome. It's not every day that you get to sit across from your icon and ask them all the questions that you wanted answers to. And that was the day for me today. If you enjoyed watching this episode, please remember to subscribe to our channel so that you get notifications every time we drop another one.